All right, let's get started. Good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the current markets. So quite a lot to get through today. And before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, kicking off as usual with the major equity indices, we are seeing some pretty interesting price action happening at key areas of resistance here, especially for the S&P 500. Heading into what is going to be a very important week. So we will take a look at where price could potentially head from here. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlight which sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today. And we'll end today's session with some bullish and bearish market observations. So before we take a look at the major equity indices, I wanted to bring back the Fed rate hike probabilities slide for today. Obviously, with this week, the two big macro/fundamental news impacts that are happening is one, non-farm payrolls is on Friday. That is going to add some volatility to equities and just the overall market in general. But also we have the Fed meeting that is currently going to be taking place today and tomorrow. Now, this is going to be a very high volatility event. Definitely, in my opinion, going to shadow the non-farm payrolls event on Friday. And that's because, a lot of investors are essentially not entirely sure as to what the Fed will do. I mean, the banking turmoil certainly threw a curveball in the works because, we had a fairly good idea of what the Fed was going to do, increasing interest rates until potentially May, June, and then start decreasing them from November onwards. But with the banking turmoil, essentially a deflationary event, the Fed can potentially reduce interest rates a little bit earlier. And that has actually seen markets play out in a more bullish tone in recent weeks. If you've seen the price action, you're seeing now that the S&P and the NASDAQ has, and technology stocks in particular that work very well in a low interest rate environment, they have been moving higher with some momentum. Now, for today's meeting, or tomorrow's announcement really, Fed futures are currently pricing in a 25-point hike. Our current target rate is 475 to 500, and there is currently a 91% chance of that increasing tomorrow to 500 to 525. So a 25-point hike, most certainly on the cards. And Fed futures tend to be quite accurate with these predictions. Over the last few months that I've been looking at it, when it comes to the interest rate hikes, it's not necessarily how much or what the announcement is tomorrow regarding the interest rate hike itself, but it's about the forward guidance from the Fed. So we may most likely will get a 25-point hike, but all eyes will really be on what Jerome Powell says regarding the future trajectory of interest rates. When are they going to start to decline? And markets will price that in accordingly. If they start to decline a little bit earlier than anticipated, that will be a very bullish move for markets, and vice versa. If it's later than expected, that'll be most likely a bit more of a bearish move. But right now, we are expecting a 25-point hike for tomorrow versus the probability of 50-point hike. Sorry, the probability of rates staying currently where they are is just a little over 9%. So a 25-point hike most likely. But again, let's see what Jerome Powell says about the future trajectory. That'll be the key event for tomorrow. Now, how is the price action looking for the major equity indices? Well, taking a look here at the S&P 500 using the SPY ETF, we can see that in the last few weeks, price has really been flirting with this area of resistance at around the 420 area, between 410 and 420. We have the 23.6 fib level on the weekly time frame at around 419. And we are seeing price, as of yesterday, actually reject that, despite going into this week with a lot of momentum. Yesterday's price action was definitely a rejection. Now, that doesn't really come as a surprise, considering that we have a few major fundamental catalysts for this week. Like I said earlier, non-farm payrolls as well as the Fed. So that could very well be the catalyst that could see the S&P finally break out above this 420 area. It's been trapped in this 420 area for a little over a year now, and we could finally see a breakout. And it's usually a fundamental catalyst as big as the Fed or non-farm payrolls that tends to accompany these huge breakouts. Now, if we get bad news tomorrow regarding interest rates, maybe they're going to be elevated for a bit longer, we could see equities actually move a little bit lower. Next key question is, where are the key areas of support that equities could move to if we do have a bearish day tomorrow and today? Well, we have support here at 404. That is a previous swing level. We saw initially a move higher, followed by a short-term retracement back to that area between the 21 and 55-day exponential moving average. And those two moving averages, that area between them does always tend to act as a good area of support and resistance, of dynamic support and resistance, I should say. So we could get it moved back down there or to the 404 level, which is the next horizontal area. I would consider that to be minor support. We also have 392 that has been a minor support level. And we have obviously 380, which is the 38.2 fib level. So those are the three key areas of support that I could see price potentially heading down to. I don't really see it heading down all the way down to 380. Earnings season so far has been quite solid. We've navigated through the big companies, the biggest companies now, and their earnings announcements. So we shouldn't have too much of a problem with earnings. I think focus will be more on what the Fed does tomorrow, and of course, non-farm payrolls and inflation. That'll be coming back into the picture. Now, in terms of key areas, upside areas that we can be looking at, we have 430, a previous swing level. That could act as minor resistance should we get a breakout. We also have the 450s as another potential area as well of resistance. So those will be the two areas that we're looking at. But overall, once we get a breakout, we can start to navigate from there. Those will be the two key areas that I am looking at for now, though. Now, moving on to the NASDAQ 100, we can see over the last couple of weeks, like many charts, I'm sure you guys have noticed, but many charts have been in this consolidation tone heading into this week because of most likely, it's due to the fact that they need a fundamental catalyst to dictate future price movements. The major equity indices have definitely been acting like that. Most stocks have been acting like that, and the NASDAQ 100 as well. So the last few weeks have been very much a consolidation, despite the bullish undertone that we've seen in recent months, especially the start to 2023 was very bullish for the NASDAQ. And now we have this consolidation and potentially a bit of a breakout. It did look like price was breaking out on Friday, but again, like the S&P, a bit of a rejection from the 324 level. So I would still consider this in the consolidation range for now. And again, like the S&P, if we do get an upside break, an upside catalyst, we have 330 as the next potential upside target, and even looking at 350 from there for the NASDAQ 100. But that is, again, longer term. I do think my bias does lean more towards an upside break here, a breakout to the upside. The reason being is if you look at the technicals, if you look at the price action leading up to this key area of resistance, there's a lot of momentum behind this move. Take a look at the weekly time frame. So we had a bit of capitulation, a bit of bottoming out here, a higher low. And since that higher low form, there's been so much momentum heading into this 320 area. And yes, price has consolidated at that level, but it hasn't been moving that much lower. So there are definitely a lot of buyers, and I think the buyers are just waiting for the green light from the Fed for a continuation higher here for the NASDAQ. Now, moving on to IWM, which is the Russell 2000 ETF. Again, underperformance against the large caps, and it has been like that now for quite some time, since the banking turmoil, really. I mean, we were seeing outperformance, if anything, heading into early 2023. We had a nice pullback to the 188 area after that breakout above the 38.2 fib level at 188. looking like it was gearing up nicely for another move higher. Banking turmoil hits and immediately price within a matter of days declined all the way back down to 170, the 50% fib level. And even though that area is acting as support, you can see there's just a complete lack of momentum compared to the S&P 500 and the NASDAQ that actually managed to continue their rally, albeit with less momentum. Small caps just have not found that upside momentum, struggling to really break above 180. And even in the last few days, once again, bouncing from 170, but rejecting 177 yesterday, set to open a little bit lower this morning. So small caps probably you'd want to avoid for now, clearly not navigating the current market too well just yet. Now, moving on to TLT, the Treasury Bond ETF, and we've had some pretty significant price action here. I was looking at originally, obviously, the 108 area of resistance that we've spoken about now for months as a major area of resistance. This has been an area that's provided some very nice shorting opportunities over the last few months. And, I would say that the 100 level initially was an area of support, but more recently, I was looking at 104 as that area of support. As a minor area of support and to play this range between 108 and 104. However, as of yesterday, that became invalidated because we see a lot of bearish price action, a lot of bearish momentum to break below that 104 level and close below that. So that signifies that support level isn't really valid right now. Yes, price is set to open a little bit higher this morning, but it does look like momentum is decreasing and it does look like price may struggle to actually reach the 108 level. We could see a continuation lower here for TLT. But again, very much dependent on what happens tomorrow with the Fed. Now, the dollar index, DXY, the US dollar has actually found some support and definitely a more obvious area of support compared to the last few months. So we have that area between 102 and 100 that I have stated for the last few months that has been a major support area. And once again, price after rallying to 105.50, a major area of support, previous support turned resistance, we saw it immediately decline back down to this support area between 102 and 100. Price now on the daily time frame finding some support, looking like it could potentially break above this consolidation range that's formed over the last couple of weeks. But again, very sensitive to what the Fed does. Any hawkish comments from the Fed over the next couple of days will likely see strength in the dollar. But right now, I do expect a bit more, potentially more dollar weakness or more consolidation. And we are still seeing a lack of momentum at this consolidation range. So a breakout, on the other hand, could see price revisit at 105.50, but a breakdown, you have 100 as the final level of support to contend with before a further drop. All right, moving on to gold. So gold, again, moves inversely with the US dollar and is also a safe haven. And that is why it's been performing so well in recent weeks. So, initially in November 2022, we had a strong move higher, followed by limited retracements, but overall, a lot of momentum taking price back to the 180s. Then we had a steeper pullback here late during February, price finding support at the 167 area, previous area of resistance turning support. And now a strong move higher, very reminiscent of what happened in early November last year. Since then, though, over the last few weeks, gold has been incredibly choppy. Even if you look at the smaller time frames, it's been very difficult to trade gold, and it has formed a bit of a support level, a minor support level at around 183. That being said, there's not a lot of momentum. We can see price, there's some selling pressure here, driving price lower, squeezing price to the support area at 183. And again, a fundamental catalyst is either going to dictate an upside break, which could see price finally touch at 192, which has been my longer term target. If it touches at 192 area, 193 area, it will form a huge triple top on the weekly time frame. So that'll be quite a significant price if it reaches there. However, if it breaks below 183, we could see a stronger decline back down to this 177 level here for gold. So those are the two key areas that I am looking at. And again, price really consolidating, really getting squeezed ahead of what's going to be a very volatile week. Right, taking a look here at oil. So looking at light crude oil futures, by the way, and ever since that gap up and a bit of a false breakout above 82, price has actually been on a pretty strong downtrend, a lot of bearish momentum. And in recent days, it has moved up a little bit higher, retraced a little bit higher, but still staying below the 21 and 55-day exponential moving average, using that as a bit of a resistance area. And for the last couple of days, on an intraday basis, has been, again, consolidating quite heavily. So we're either going to get a breakout or a breakdown. And right now, oil's in the middle of no man's land, in my opinion. It's right between this, in the middle of this range between 72.50 and 81. A breakout could see price retest at 81, 82 area, but a breakdown could really further, test this area of support at 72.50 to 70. So the 72.50 is a lot closer to where price currently is. And if price does reach that level, that might provide a nice risk-reward bullish entry point for the move higher back up to 81. Now, when it comes to oil prices, over the next few weeks, I think it's going to be recession fears that really dictate market direction, in addition to the general fundamentals surrounding oil prices, such as OPEC cuts and what OPEC does. But for currently, I do think recession fears are still creeping in. It's definitely been a bit of a headwind for oil over the last few months. And if interest rates remain elevated for longer than expected, that would increase the likelihood of that would increase the recessionary risk, right? That would essentially scare oil investors a bit more. So we could see price decline if there's a more hawkish message here from the Fed. Okay, moving on to sector rotation, we have 5 sectors in the improving and leading, 6 in the lagging and weakening categories. Now, not much of a change really from the last couple of weeks. Communications and technology have been losing a bit of momentum, but still staying in that leading category, providing leadership. And if anything, over the last couple of days, have actually gained some momentum. Now, nothing in the weakening category. In the improving category, we have our 2 defensive sectors and our 3rd defensive sector in healthcare. We have utilities and staples, in the improving category, showing good momentum, showing good improving relative strength. And we also have healthcare rotating into the improving category. So our 3 defensive sectors are essentially all in the improving category. That being said, if I look at the daily time frame on those charts, definitely, again, consolidating like the rest of the market, really, but not really showing that much buying potential just yet. So we could see a rotation back into more riskier sectors like technology, like communications, if we get a dovish message from the Fed. And if not, we could see rotation back into the more rotation into these defensive sectors. Now we have real estate performing quite poorly, losing out on relative strength and momentum. We have energy, on the other hand, finding some momentum. That's due to the fact that oil prices did move a little bit higher. Financials naturally still performing quite poorly, despite the fact that JP Morgan did purchase some of the PNC's assets. It hasn't really, it's not really going to help the broader situation for the banks, in my opinion. Maybe a little bit, but nothing too significant. We also have industrials and materials losing out on momentum and relative strength and getting deeper into the lagging category here. So moving on to some subsectors of interest that I have for you today. First one is DRIV, the Autonomous and Electric Vehicle ETF. Now, this is more on the daily time frame, and we can see here there's definitely some selling pressure with this bearish trend line. However, there is horizontal support and very strong horizontal support at around the 22 area. Price is forming a bit of a double bottom here at 22, bouncing higher. And even though we had some bearish price action yesterday, what we could see is a potential retest of this bearish trend line and potentially even a breakout. Again, it depends on what the broader market does, but from a risk to reward perspective, it definitely does point to a more bullish picture. There's more reward here, there's more upside potential than there is downside, because if it does break below 22, that this thesis becomes invalidated and you get to cut losses on the trade a little bit early. Whereas there is lots of room here for the upside for a potential rally here for DRIV. So quite a simple trade setup here, but looking for a breakout of this trend line. And again, assuming that horizontal support should hold. All right, taking a look here at TAN, another subsector that we haven't looked at for quite some time now. This is the solar ETF. Now, very choppy price action, as you can see on the weekly and on the daily, right? It's been very difficult to trade TAN. However, overall, price is still somewhat range bound between the low 80s, 81, 82, and the low 70s. I would say 70, 71 has been acting as that area of support. Now, on Friday, we did see a strong intraday bounce from that $70 level. And even though yesterday price action was still quite bearish, and we're not really seeing as much bullish price action at this area of support, this is definitely a name I'm having on my watch list over the next couple of days. Again, like DRIV, very good risk to reward to the upside. So patience might be required, but I will definitely be looking for bullish price action anywhere in this area between 70 and 72 for a nice risk to reward upside entry point. Be looking for target prices would be at around 78 as a potential take profit zone. And for those of you that want to hold on to the trade even longer, you have a stronger area of resistance at 84. So those would be the two target levels that I would be looking at for TAN. So moving on to PayPal from last week's idea, bullish idea on PayPal, 72.50 acting as support. And that was the thesis for our bullish trade setup. Now, overall, yes, PayPal had been on a very strong decline from the pandemic recovery period. I mean, its valuations were just crazy high. It was just completely overvalued. Now, what we've seen here on the daily time frame is definitely some capitulation. We are seeing, a bit of a higher low form from 67.50 now to 72.50. And price, even though there's a lack of momentum, it's still holding at 72.50 level. So far, the thesis actually does hold. Because the thesis was a neutral to bullish move with price touching 72.50, that provided a nice risk to reward credit spread or put credit spread, which can take advantage of a moderately bullish or neutral price action with PayPal. So it's definitely a trade setup that's still working for us despite the lack of upside. However, it does look like it's a very tight range. And with the highly volatile week that we have, it may make sense to actually think of closing the trade early and taking some limited profits, but closing that position and securing those limited profits. Again, there's not a lot of momentum on the higher time frame, and price is still not showing that momentum to break above this consolidation range. Again, like I said, with the major indices, there could be the fundamentals this week could definitely act as a upside or downside catalyst. But for now, for PayPal, if you don't want to have that additional risk, there's nothing wrong with closing this position before what's going to be a very volatile week ahead. Right, moving on to FIS, so Fidelity. This is a new idea, and this is a bearish idea. You can naturally see on the weekly time frame, very strong bearish trend from the pandemic recovery period ever since then. And a very systemic trend. I mean, if you have it's very reminiscent of the charts that we've had in the past, such as IBM or Intel, where previous support turning resistance at 104, you have previous support at around 85, turning resistance. You have resistance there at 80 as well. And more recently, we have previous support at 60, turning out to be resistance, that range. The daily time frame has a more clearer picture on that, in my opinion. So a strong move lower, followed by a bit of a retracement higher, and price struggling to break above its the area between the 21 and 55-day exponential moving average. And you guys know that I like to look at entry points when price retraces to that level. Also, the fact that there's some horizontal previous support turning resistance in and around this area that, again, further justifies a bearish outlook for Fidelity. So I would be looking for a move lower, targeting low 50s or even 48, or potentially even a new lower low here for Fidelity. Right, moving on to Apple. So an older trade idea that we've had, a bullish trade idea that is still working out very well so far. Strong bullish trend. Our target price was between 180 and 175. And so far, price is approaching that area. So finding still some very good momentum on the weekly time frame. Let's see how much longer that lasts. But right now, this is more of an update. There's no real reason to close this trade, or there's no, unless we want to shy away from the volatility this week. But right now, there has been nothing to suggest that there's been an invalidation of the bullish thesis here for Apple. Right, moving on to IBM. This is a bearish trade that we've had over the last couple of weeks, and it's a bearish trade that's been working out very well for us. IBM was a bearish trade a few months ago due to the fact that it was a very systemic bearish trend. We had a new lower low using the previous 137 level as resistance, and price made a new lower low after that at 122.50. Since then, we did see retracement higher to the previous area of support, the previous swing level, turning resistance, and that provided a very good risk to reward bearish entry point. We did get a bit of a scare with price opening at 130 the other day, but immediately declined. And there's a lack of upside momentum here. Price action very bearish. I still think that 122.50 is still on the cards, potentially even 115 or let's say 117 or so, that area. That could be the new lower low to really complete the setup for IBM, which the weekly time frame hasn't been zoomed out far enough, but it's been in a multi-year range-bound market between 150 resistance and around 115, 120 support. Right, and a new idea that I have for you today is CBRE group, ticker CBRE. And this is a name that is part of the real estate sector, a very big name in the real estate sector. What we've seen here is some very bearish price action, right, in the last few days. But if we take a look at the weekly time frame first, we have a bit of a range-bound market with 88 acting as major resistance. We have another area of resistance at 80, and we have 68 acting as a strong area of support. Now, what I've seen here the more recently is on the daily time frame was this very strong move lower, all the way from 88 to 68 in a few days. We have some consolidation, a bit of a breakout higher, but price a double rejection of 78 in the last two trading sessions. So from a risk to reward perspective, this looks like a very nice bearish entry point for that move lower. That being said, if price does break above 78, I would look at potentially closing this trade immediately, because that would invalidate the thesis of price rejecting that 78 level. So CBRE group, with the real estate sector itself being very, very weak, I think there's a good risk to reward bearish opportunity for this name. All right, guys, and with that, that is all I have for you today. Thank you so much for joining me, and I will see you tomorrow for a Firstrade education webinar on the wheel strategy, I believe. So very much looking forward to that, and I hope to see you there. Have a great trading day, everyone, and yeah, see you tomorrow.